Hello listeners, welcome to Money Talk with Patrick. I am your host Patrick, trading mentor and creator of TC Trading. So in today's episode, I will be talking about the different types of economic recoveries and what has been the response and consequences of the unprecedented money printing in the economy. I will also give my opinion on where we are right now and what we could potentially expect in the near future. So hello once again everyone, I hope that you've been great, I hope that you're having a nice week. Let's talk more about money, let's talk more about finance. And the first thing that I want to talk about is the different types of economy recovery. So we have seen throughout the pandemic, in 2020 that all markets, mostly all of the markets had a very, very big crash. If you name Bitcoin, if you name the S&P 500, if you name any type of market out there, gold, whatever it was, it really came down because of the crisis situation. Now, I hope that you have seen or you have heard the different types, or at least one of the types of economic recoveries. Remember back then in 2020, around it might be more or less about around May, people were talking about this V-shaped recovery, okay? This is basically where the markets go down, and as it goes down, it goes up. So this is kind of like very positive in an economy when you have this type of recovery. So that's the first step, it's a V-shaped recovery, and as you might expect, it has the shape of the letter V. So it comes down, it makes pretty much a support or a point of resistance for the price not going down any lower, and then it bounces right away. Now, another type of economic recovery is what's called the U-shaped recovery. Very similar to the V-shape, it's pretty much the same, except that instead of bouncing right off, of having kind of like this bottom, it takes a little bit more time, and then slowly but surely it starts kind of like gaining more momentum. So it's basically the same, the price goes down, it takes more time, but in the end it recovers and it goes higher. Now, another type of recovery that you have is the W-shaped recovery, and again, this is just pretty much naming letters and you thinking about the price action or looking at charts and imagining those same letters with the same price action. So a W-shaped recovery means that the market crashed, then it tries to bounce, it tries to get back, but it fails once again, and then the second time, that's when it really kind of like recovers completely. And the last one, which is kind of like the least desired outcome, is the L-shaped recovery. Again, imagine it's an L, that the price is actually going down, but instead of quickly recovering, it's recovering but at a very slow pace. Why is this important? I wanted just to let you know about the different types of recovery, because I'm gonna be giving my opinion about the current state of the market and also what we could be expecting in some time. But first, let's talk a little bit about the response of central banks. So for all of you who don't know about quantitative easing, it might be a word that sounds, if you're familiar with finances, but in a more formal term, quantitative easing is when central banks purchase longer-term securities from the open market in order to increase the money supply and thus encouraging lending and investment. In an easier term, if we're trying to kind of make it more digestible for you, an easier way to look at it is increasing or decreasing interest rates or the cost of borrowing money. So if you guys are already kind of like getting credit cards, if you are already getting like mortgages, if you are getting like car loans, you already know what interests are. And basically interest rates is just the rates that the central banks usually put for every other bank. Now, grabbing the US as an example, in 2010 all the way to 2015, interest rates have been almost zero, very close to zero. And in 2015, it was when Donald Trump started increasing interest rates a little bit, all the way above 2% more or less before 2020, so before all this crisis happened. In order to tackle a potential recession, I mean, we did have a recession, but it was very brief in comparison to what it could have been. The recovery was extremely extremely fast due to what happened with COVID. But the central banks, of course, across the world decided to lower interest rates almost to zero again. Why? Because if there's panic in the markets, with interest rates going as low as possible, that would incentivize you to go and buy more things to keep the economy afloat, to keep the economy or this cash flow moving through all the different countries. Now, there's a certain point that central banks can't lower interest rates anymore. Of course, this point is of course zero. Of course, this can turn negative, but I'm not really gonna be talking about that in this episode of the podcast. But when they can't go even lower, because we have to really think that the pandemic had an extreme effect. Like when I'm saying extreme, perhaps most of you have not noticed it because it's very difficult to notice exactly what happens all around. But I remember even not long that I went for a walk. I actually went to get a haircut, and I started to see some lots actually for rent. Where there were businesses before, potentially because of the pandemic, because they cannot really afford going without business for so long and paying rent, they were starting to kind of like quit, to kind of going bankrupt, or maybe just they decided to to take the losses and just close their businesses. Now this is important because the response that we have seen from the central banks first was, yes, decrease the interest rates as low as possible, but that wasn't enough. With the lockdown, the small businesses, the economy around a lot of places wasn't able to operate as usual. So what they end up to do is kind of like this economic stimulus in various ways. The most famous is kind of like directly printed more money and basically give a check to every citizen. On depending on the specific country, they have different programs. But the point is that they started printing more money. Since 2020, more than $3 trillion have been printed to increase the money supply. Now, this is talking about 2020, because if we talk about 2021, with the Biden administration, I think there's still an ongoing 1.9 trillion. So these figures that I'm gonna tell you about, they're old figures. Probably, we're talking about more. We're talking about close to $5 trillion having printed since 2020. Now, by that time, 2020, $3 trillion was more than 20% of the total amount of money in circulation. Just let that sink in your mind. 20% plus 1.9 this year, we're talking around potentially 30 to 40% of the total amount of money in circulation in just 2 years. Now, this has created a lot of speculation, and a lot of markets like Bitcoin, cryptocurrencies have just exploded to the upside. If you see the stock market, it has gone rampage to the upside, breaking all-time highs, despite how kind of like all the economy around is. I mean, we're talking just about the stock market, and it's very different to talk about the stock market than the economy overall, okay? Of course, this was in anticipation of inflation, but it's important to think, why haven't we seen hyperinflation, right? Why? I mean, just ask yourself that question. Why haven't we seen like really this crazy amount of inflation, despite the US printing almost 20 to 40% of the current money in circulation that they had? You would expect that, okay, with that extra money, prices all around would potentially increase up to that rate, but this is not the case. Now, the reason is because hyperinflation, it really depends on different aspects. For instance, it depends on the industrial output. That's one of the variables, right? Meaning how much the industry is actually producing products. And this kind of is roughly the same in the terms of how it affects hyperinflation, because of course industrial output went down but also there was less demand due to the crisis. And also, like, if you see that there were some times during the lockdown that you could not buy things that you wanted. It was like only essential items, and this is potentially not only for one reason, which is like not trying to spread the virus anymore, but it could potentially be also so that inflation is not affecting more products. So with industrial output basically kind of like being a neutral point, we also have some other ones. First, employment. Okay, now why employment affects hyperinflation? Basically because the less employment there is, means the lower the wages. Okay, because people are gonna compete more for the same jobs. Since there are really no jobs, then you have a lot of people trying to compete. And what's the best way to compete is by gaining skills and kind of like sell them at underpriced levels. So basically people are going to be competing against each other, and the value of the different jobs is going to go down. Now, of course, if you think about it, why does this reduce hyperinflation? Is because if there's less people, or if there's more people wanting the same jobs and the salary goes down, then they effectively have less money to spend, and thus it reduces hyperinflation, or the chances of hyperinflation. And of course, this is a negative kind of point in terms of the economy, but this is something that's reducing the chance of hyperinflation, at least for the time being. Another point is the money supply. Of course, this is the easiest to understand, as I just said. If you print more money, of course, this is kind of like a positive, or this will drive hyperinflation in a certain way. More quantitative easing and stimulus from central banks is gonna increase the supply, and thus the chances of hyperinflation in the future. And the last part, or the last point that I would like to talk about, is the velocity of money, which again, if we think about the overall economy, it is down. Why? Because people do not want to spend money, right? I mean, if you are in a moment of crisis, if you are in a moment that you are scared about losing your job, or you don't have a job, you're not gonna be spending with everything, right? You're not going to be going out and trying to spend as much as possible. It's going to be quite the opposite. So because of this, the velocity of money, or the velocity of which the money transfers from hand to hand, when you purchase products, you're basically paying for someone else's salary, and then this repeats itself a lot of time until you kind of receive something on your end. Now, if we talk about the recoveries, now this is kind of like my opinion, but also based on research that I've done. I want to explain what's a K recovery. This is not something that a lot of people have heard about, and it's something that is actually popping up very recently. So a K recovery is when different parts of the economy recover at different rates, times, or magnitude. So after COVID, the retail industries, the software services, we're talking about Amazon, we're talking about, for instance, Netflix, all these kind of like cloud-based services, or even entertainment industries, but that are software-based. We're talking about tech industry as well, Facebook, Google, they have all gone up. Why? Because, of course, people were staying inside their homes, and, there was no other option. Make the products go to your home. But while this might sound a little bit positive, you need to take a look at the other side of the picture, right? The other side of the coin. And that is that traveling, tourism, entertainment, like going to the cinema, going to bowling, going to, I don't know, you might think about different forms of entertainment, like going to bars, etc., etc. Food services, even though you have Uber Eats, you have different platforms, they are really affected. Of course, you're not going to have the same number of orders online, or it's not going to be as efficient because you have to pay a commission, and it might be slow because you depend on the number of drivers or whichever amount of delivery there's available. But the point is that all this has gone down. So you can, if you try to see this in a chart, you would see that Of course, the prices starts coming down, and that's for all the industries. Then the tech industry and all the software and retail services are going up, while these entertainment and food services are stagnant or even going down. And this is where you have this kind of like K shape in the graph. Now, the best way to see this again is to see how the stock market was hitting all-time highs, just as I said before. But despite this growth, you still have a lot of unemployment. So, you can see Wall Street hitting all-time highs. You can see Wall Street getting more millions. You can see millionaires becoming billionaires. But all of a sudden, if you turn around, you're going to start seeing that small businesses are closing. You're going to start seeing that more people are unemployed. You're going to start seeing that, kind of like this crisis is not really over. You might think of finance as being the stock market, but it's not the only part of the overall economy. It's just a very small part, right? It's not the whole entire picture. Now, what to expect? That's a very tough question, to be honest, more in this area, because in my opinion, growth in the stock market and most markets, in my opinion, again, it seems very unsustainable. We are talking about global debt. The global debt is rising. The UK, the US, they owe pretty much trillions, or there's a global deficit, even though that some countries can be lenders as well. Countries are slowly but surely getting over leveraged. There are more countries that are actually getting more debt in order to boost infrastructure, boost certain projects. With the pandemic, the resort was trying to print more money, which in reality, in terms of inflation, it has not affected us just yet. But with everything in life, there's nothing as a free lunch. If you talk about kind of like science, there's nothing as creationism. You cannot create something without affecting another side. There's always this equilibrium. Just like matter and energy, you cannot create or destroy it. It's only transform. And the same goes with money. You might think that you can create just dollars out of a printer, but in reality, there's gonna be another form of impact to compensate for that. So, as I said, just to summarize, chances are that fiat money is going to have less and less value over time. Of course, we already know this, and assets like gold and Bitcoin might benefit from this in the long run. Now, this is different because if there is another big crash, most likely everything will go down, despite what I've said, despite being gold and Bitcoin, that they don't really have the same amount of inflation as potentially fiat money, but they will still go down. If you remember, before 2020, or just in February 2020, most of the stock market, Bitcoin, gold, they were very correlated markets. All of them were very correlated. And, if you saw a lot of videos on Instagram or a lot of videos in YouTube, people were skeptical and people were saying it's not correlated. But the fact is that they were correlated to a certain extent, and it has never, that has never been seen before. But that was a result of the crisis. Now, if there's another big crash, we can expect more or less the same. And the reason is because if you resort to your basic needs, meaning buying food, buying somewhere to live, services that are required for you to survive, what's the only way that you can actually get them? Well, the only way that you can actually get them is with cash. You cannot pay things with Bitcoin. Yes, you can have cards that basically instantaneously cash out your Bitcoin and sell it for whatever product you have, but again, it's selling that thing. It's not really that right now you have prices in Bitcoin that are not fluctuating. Okay, so that's kind of the thing, and this is why in recessions and in big crises everything goes down, at least initially, because people are getting kind of like scared, and the only way to really satisfy those needs is with cash. But in any case, traders and listeners, I hope you found this episode of Money Talk with Patrick interesting. It is very important to keep learning more and more about finance and the current economic situation. Even though you think this might not affect you, being aware might give you an edge to not be fully impacted if the worst came to happen. If you want to learn how to trade and short the market if things go south, you should definitely check my trading course. Just go to www.tctrading.com to learn more. Thank you very much for listening, and I will see you in the next episode. Take care.